Good morning. Hope you're having a great morning. You have a cup of coffee with you? I hope you do because we're going to need it. It is a happy Friday, and I'm trying to do more of a market wrap up on Fridays. So I thought we would do that today. Before I jump into that, though, I want to talk a little bit about an article I read. This is a magazine I get. It's basically for certified financial planners, and it basically talks about a lot of things that are going on in the world of planning and advice. And there was this really interesting report that was made where they interview a lot of people. There's this organization called the Financial Wellness Report, and they highlight what the consumers' anxieties are, what they're really looking at. And it was really interesting because it highlighted that COVID has had an impact on people. And I'm going to tie this into the markets because I think it really explains a lot about what's happening right now and what to expect as investors. So I just want to talk about what the priorities that people are finding at the top of the list. And it really explains the market movements that we're seeing and what we can expect. The first concern, I mean, a huge concern, is building a cash reserve. A lot of people, I guess, their cash reserves have been dwindled, obviously, if they lost their job or if they had to do some kind of a change. That has created a need to build more cash. So we've seen more of that happening. And then the second thing is continuing to save for retirement because a lot of people, I guess, either stopped saving for retirement or lowered their amount for retirement. And now they're picking that back up. And we've seen that actually in the real numbers. A lot of people have also not only started saving more because they wanted to or they had to, or I should say were able to. They were always able to for a lot of people, but they just now started to do it because they felt more confident. So that is affecting that number. And I think that explains a lot what's going on in the market right now. And I'm going to dive into the markets a little bit here in just a second. So they've been delaying purchases. So a lot of people have been delaying purchases, and not always because they can't make the purchase, but because of psychology, how we feel about what's going to happen with our jobs and things like that. But those delayed purchases now are actually coming lower and lower on as a concern. So we're starting to see that come up in the stocks. The different types of stocks now are starting to benefit from that, and that's a big thing. The other thing is making contingency plans for next in line sources of cash. That's not a real clear one, so I'm going to skip that one. Getting estate planning in order. So a lot of people, when you start thinking about having a life or death disease that's spreading throughout the whole world, people start thinking, like, if I died, what in the heck am I going to do? I don't have my affairs in order. So more and more people are starting to get that in order. And I highly recommend uh, doing that and increasing life insurance coverage. You'd rarely see that, but that's another one of those things, kind of the realization of our mortality has created people wanting to look at more life insurance. And a lot of people are wanting to pay off debt, which I think is a really good thing because as a nation, we have too much debt and we don't have enough savings. And if you watched my talk yesterday, I talked a little bit about that in terms of like why we are, uh, uh, how to deal with saving more and how come we save so little as a country and how you can up that. So if you haven't seen that one, go back and check out yesterday. So that would be March 25th. That video, I talk a little bit about the reasons or how people can go from not saving enough to saving more, what they need to save. So if you like this information, be sure to subscribe. And also, you can talk to me right now. We can actually have a conversation. So if you just comment, I can see your comment and I can actually show that up on the screen like you can see right here. Ask me any questions that you have or comment on anything, and we can talk about it back and forth. Makes it a little more interactive, a little more fun. So, what my question for you is, what are some of the top priorities that you see, and do you think the market is going higher from here? Now, Biden had his first kind of real conference call, or I guess it was a press conference, but it didn't kind of seem like a full press conference because there wasn't as many people there. that was normally there. I think the market is kind of digesting that too in terms of what that means for interest rates. And that's why I titled today's talk about the markets grinding higher. So, what do you think? Do you think the markets are going higher or lower? Just type it in there, higher or lower. And also type in there where you're from. Just say hi from Denver, Colorado, or wherever you are. I'd like to know where you are. Um, let's dive in a little bit into the markets. So I'm looking at one of the first things I do when I look in the markets, and I really want to look at the sectors. I want to see what's happening in the sector groups, and to see whether or not that is affecting. What does that mean for the economy? So as we look at the sectors, we're seeing that the financials continue to be kind of the leaders, the financial and energy. And that makes a lot of sense, right? Because financials are making more money, mainly the banks. They're making more money if rates rise. And we've been seeing an uptick in interest rates, which is allowing them to make more money. The reason why they make more money is because the longer term interest rates, if they go up relative to the shorter ones, they make money on the margin between the two, the difference between the two. So that's really helping them. And they've really been under pressure for a long time. They're very undervalued. So financials continue to do well. And the energy, the oil stocks, the refining stocks, they continue to do well. And that, of course, has to do with the fact that we were at such depressed levels that now that we're starting to open up, people are driving more. I mean, you just go downtown in Denver here or any major city, and you'll notice it's starting to pick up. Even when we were in California, we noticed that things were picking up. And, people just seem to be a little more at ease. So that's one thing to consider. Now, getting back to the markets, on the energy stocks, if you don't own energy stocks right now, and I think a lot of people don't actually, it represents a very small part of the overall S&P 500 or the overall stock market. So that's you have a potential to actually do a lot better if those energy stocks continue to do well. So I think a lot of people are underweighted in energy, don't have enough there, and they also don't have enough in the international stock market. So like today, emerging market stocks are up 1.7%, and small caps, which is another area that we've been emphasizing, that's up 1.6%, whereas the S&P 500, which is just your large cap 500, that's only up 0.57% today. So you can kind of see that bifurcation of what's happening here overall. And really the sectors that are driving it is the basic materials and the energy, and real estate starting to come back. Real estate starting to come back, but that makes total sense. So many people are starting to go back to the office. And as they go back to the office, that should help rents. And that whole sector is beaten down pretty hard. So that's a good pocket of value. What's not doing well right now today is the utilities and the consumer staple stocks, the more the safety net. But what we've been seeing is this grinding movement, this movement where it's not been just everything moving up. So kind of the easy money has been made off the low that we saw in March, off the pandemic low. And now we're getting to more of a grinding where people are kind of digesting the gains, because a lot of the stocks that did well in the past, their fundamentals don't look so great. I mean, I was just looking at, I couldn't believe the numbers, the market cap numbers for Tesla and for Apple. I mean, Apple's market cap is over $2 trillion. Yeah, I mean, it's kind of insane to see what's happening there in terms of value. And that, people are just trying to make that digestion there. And that really ties into what I wanted to talk to you about, this report, because now we're kind of getting into more of the older companies, the industrials, and the companies that are, major purchase oriented, and people feel more confident. That is affecting those sectors that you generally consider to be coincident sectors, meaning that as the economy does better, they tend to do better in terms of earnings. You can kind of break up the market into early, mid, and late cycle. And what we're seeing right now is kind of the mid cycle companies starting to move higher, which would imply that we're kind of hitting our stride, and that's a good thing. But you usually have some setbacks during that time. Like if you look at the market cycles historically, and when I'm talking about market cycles, I'm talking about you take the business cycle when you go from recession to expansion to contraction and recession. That would be one full cycle. That one during a full cycle, you have the early stage, and that's, kind of like the usually the home builders and stuff like that. So we have a little bit of that going on too. Those have already had big runs, and then some of the financials are hitting. But then as rates start rising, you have this demand increasing. Then you see more of your coincident sectors like the industrials and the energies tend to be more late cycle. So we're kind of in a very interesting position where we are because of the nature of this last recession that we had. But we are recovering. We're looking at a 6% ish type growth. That's the forecast right now in GDP. And people get really really confused because I remember when I was doing a lot of quantitative work for a fund back in Estes Park, we did an analysis on corporate profits and growth, and I was doing a lot of statistical analysis on what do the markets do when earnings are doing well. So I did a lot of regression analysis and a lot of market indicator development, and looked at how it affect the how it whether or not it was predictive of stock prices. And what's interesting is that the actual growth rates, as they increase, actually there is a negative uh, forecast for stocks in the future. So, and people get confused on that. And the reason why is because usually interest rates are part of that. So, as once the earnings are actually released and the corporate profits are actually released, that things have already happened. There's a big lag, and the stock market is ahead of the game, right? So if you, just because you have big numbers right now doesn't mean the stock should continue to go up. It's kind of history. The market is looking at where are we going from here, and so I would just keep that in mind. So even though you see these big numbers, it doesn't necessarily mean that stocks are going to do better. Do better. They're probably going to grind more, I would say. So it's more of a stock pickers market right now, and that's really what we're seeing. Um, what was I going to also tell you? So do you think the market's going up? I think a lot of people do think the market's going up. And yeah, I'm getting kind of a radio frequency, which is kind of interesting. Anyhow, so getting back to the stock market, interest rates are always another area that we want to look at. So let's talk a little bit about that. Today, what's happening is we're seeing that the high yield bonds are continuing to move up, and that's where we have most of our exposure right now is in high yield bonds. We also are seeing more exposure, more increases in the TIPS, the Treasury Inflation Protected Securities, and I think that's more of a function of the fact that there is some concerns that inflation is rising, and we've been talking about that a lot, and I think that's going to continue to happen. But the long bond, the long-term interest rates are rising today again, and long-term corporate interest rates are rising. So I don't think that we're in a scenario where we can just say the Fed's going to kind of bail us out and buy that long end of the yield curve and keep those rates down. That's been kind of the expectation, but we have been hearing some talk from, like, recently, as I was talking about yesterday, the Dallas Fed chair basically signaled that they would not do that, that they would not do that as much. So anyway, that's just a general overview about what's going on in the market. So hope you guys are having a great day, and we will talk to you later. Bye.